The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
And that rockin' music means it's time yet again for the Option Block. My name is Mark Longo from the OptionsInsider.com as well as the Options Insider Radio Network. And we're looking forward to another fun Option Block episode. And I am joined here on the panel by two of our recurring favorites, starting off with the man holding down the Options Express hot seat, none other than Big Rob Kurzakowski himself. Rob, welcome back to the show, sir.
I'm doing well, Mark, except for the another yawner of a day. After we had a little bit of excitement last week, I think we're going into back into the yawner trading sessions once again.
Yeah, it certainly wasn't too much lighting up the old tape today, but to help me parse the action we did see today, we are also joined by the man from Maine, a.k.a. Mr. Lobster himself, good old Andrew Giovinazzi of Option Pit fame. Andrew, welcome back to the program as well, sir.
Thank you, Mark, for that fine introduction.
All right, so with the team mostly assembled, we're going to dive right into the trading block.
The Trading Block.
And welcome to the Trading Block. This is, of course, the portion of the show where we break down and parse and analyze what was going on, what was moving the street today. And as Rob alluded to at the top of the show there wasn't a whole heck of a lot really moving the street today. Most of the major indices closed down unched or down slightly on the day. We had the S&Ps down a little over 3 handles to 1313. The Dow down 6, almost a whopping 7 handles to 12653, and the Nasdaq down almost 5 handles to 2811. The good old VIX cash eking back to the upside, up about 0.9 to 19.43. Of course, a lot of that is the old weekend popping back as well, so maybe a little bit larger move to the upside than we might have expected otherwise. Perhaps we'll start there. Andrew, we haven't had you on in a couple of shows now, so what's your take on what's been going on with the old VIX? I know last time we talked, I believe you were of the mindset that given what we're seeing in terms of actual realized vol, that the VIX has yet more room to move on the downside. Are you still falling into that camp?
I think we're starting to run out of a little room here on the downside. There was okay action almost in line this morning when we were down about, 0.75% or something like that. I'm starting to, the VXX is starting to hold around here around 26. We were kind of breaking through levels on these things, and it's kind of stopped. So again, I think the underlying vol is still going to pull these things down, but it's having a hard time now to find some willing sellers anymore. I think that our initial flush with Apple earnings were great and things like that. Now we need to find reasons to sell again. As you can see this morning, anything about Greece, now the market only gets lit up for about 10 handles on the on the SPX instead of the 30 or 40 handles.
Yeah, like it
was lit up in October, November,
exactly.
December.
It is interesting. You have to be a real big proponent, I think, of realized vol and that realized to implied premium to really come in as an aggressive seller now. If you weren't selling the realized to implied premium back in, let's say, October, when it was many handles, looking at 30 odd in the VIX versus a realized of in the low 20s, that was a far more attractive sale. Of course, a lot of things are going on in the market that kept people from hitting those bids. Now we have some people feeling a little more comfortable, obviously selling VIX below 20, but once you start getting at these levels, you have to be pretty aggressive to want to eke out those last couple of points versus putting on that risk of Europe melting down yet again or something else along those lines that sends VIX roaring back up into at least the mid-20s, if not the 30s again, if even for a few brief moments.
Yeah, it's just a lot. I think almost it's the pure volatility play, just fading it is almost gone, and you're really spending some time now on the fringes and a lot of the out of money options, and in the VIX. Of course, we don't like having people just sell lots of naked VIX calls, but those call spreads and things like that are a little more out of the money. And also the volatility has been trashed in those indexes. There was a little opportunity this morning in the VXX to put on time spreads for volatility credit, but that evaporated fast after, basically Greece was upset that they're not a sovereign country anymore. I don't know when they finally got the realization that they don't have control over their sovereignty and their budget, but I guess the Germans kind of squared them away on that. So we'll see how all that plays out. I mean, the political thing still could happen, obviously, but the market, I think, is discounting it pretty substantially at this point.
Being just kind of looking at the VIX futures and the way that the contango is in the VIX, coming from the commodity world, typically, we see this type of contango kind of curve when we're in a bear market. Back when crude oil was kind of in its funk where it sold off and it was just trading sideways and not doing a whole lot, we saw the same exact type of the same exact type of setup. And you're looking at the VIX futures, there's a pretty good contango until you get to like July, and then it kind of levels off to August, and in September there's not a whole lot. It kind of levels off between those months. But when we're seeing the volatility kind of get beat up all over the place, in the OVX and GVX and GVZ, we see commodity volatility has gotten the snot knocked out of it as well.
Do you think it's the same phenomenon, Rob, that's been at play lately in the equity markets, which is people just seem to be overnight waking up to the disparity between realized and implied vol, and they're just whacking the heck out of the implied? Or you think it's something else underlying that root cause of this selling across the board, euro, oil, VIX, you name it?
I think it's a combination. Obviously, the options, astute option traders out there are looking at the realized versus what the indices were implying, or what the options were implying, and saying that this is just this is out of whack and beating up some of the premium. And there's also some general calm at this point. People just become kind of numb to the Greece and Europe news. You get so inundated with it that you just become kind of complacent.
Yeah, I wonder what the decay is on Greece news. What is the decay factor on how that news affects our equity market?
You're talking minutes now, I think. Whereas I think the half-life of that was definitely in hours, if not days, a few months ago. Now
Right.
you're talking minutes. It comes in, it hits the market briefly. People tend to shrug it off. Like the most recent news that you mentioned, that Germany is now telling Greece that they get to wear the big boy pants for a while, and Greece needs to just sit in the corner and let the big boys sort it out for them.
Yes, totally, and that's
that has to be completely demoralizing.
Ruin, guys. You're going to have to take the pipe for a couple years. Your economy's not going to grow while you restructure, but you're going to be look at all the Asian countries. Look at Indonesia. Look at Thailand. Look at all of those countries, South Korea, that bit the bullet in 1998 when they had basically the fast money currency crisis, blew everything up. It was a bad year. And, but literally 8-9 months down the road, things started recovering because they rebuilt from a stable base. It's just, it's just trying to get the religion in their head that this is what you need to do. I mean, now Asia's probably driving economic growth. That's what it feels like. Buy more Caterpillar. I don't know. But that's what Europe is. They have not totally flipped over to that side yet, what's necessary. But every other economy, save for the U.S., Asia, Latin America, they all had to go through these, this crisis. And now Europe's going to have to deal with it. Everybody knows it's inevitable because nobody's going to loan them money. So and I think that's where our volatility is right now. We're on that, nobody wants to sell it down, but I think they're going to let it drop. Different type of game.
Speaking of Asia in the future, an interesting and moderately disturbing report came out of Japan, I think a little while ago, it might have been yesterday, that they're expecting over the next 50 years a dramatic population decrease in Japan, something from on the order, I believe, of 30 to 40% in terms of an aging population, a low birth rate, and all these combined effects are really just going to hammer that population going forward. So not exactly a rosy outlook for Japan and Japan's economy if those trends continue as predicted in that report.
It only takes a couple of years to change that, though.
The Japanese just need to get a little busy over there, and then
exactly they get back on the workbench. That's easy to fix.
They can turn all that around. There we go.
Exactly.
Rob, anything else lighting up your tape on the commodity front, or perhaps some of the interesting stuff you saw coming across your desk today over at OX?
Well, commodity-wise, we really saw the markets just kind of pull back, and especially in the precious metals, just didn't go into a holding pattern. We had a bit of, kind of exuberance after China had a better quarter, and that kind of spilled into last week. And then,
would you term it irrational exuberance?
No, not irrational, but I think now that you're starting to look at some of these projections for Chinese growth this year, a lot of people are seeing quarter over quarter, China is seeing the growth rate drop by a full percentage point in the first quarter. So certainly a lot of indecision, but every time people seem to revise down Chinese forecasts, that they still outperform those diminished forecasts. So, but the People's Bank of China does have quite a bit of flexibility with what they can do, because if you look at what prices were doing at the beginning of last year versus the tail end of last year, we saw raw material prices actually decrease by about 2%, or saw a 2% decrease in the growth of prices. So they can certainly be more aggressive, and but we saw some of that kind of hurting the Australian dollar because of that symbiotic relationship the two have.
What really crushed, not to cut you off, but what really crushed the Australian dollar is, of course, that ongoing scandal just breaking out of Australia that they have replaced the yellow wiggle yet again. And for anyone who has a little kid in the Wiggles age group, they know what a terrible catastrophe that is. And, of course, they are the biggest, probably gross revenue producer coming out of Australia. So when something happens to them,
their largest export.
Exactly. The shockwaves are felt throughout the throughout the Australian economy. I mean, if something else happens to Paul Hogan, that would pretty much be it. I think Australia would have to shut down.
Wow, why did they? I wonder why they ditched the yellow wiggle.
Yeah, they brought the old guy back apparently, and that's causing all sorts of firestorm about how much they paid the other guy when this group is making or at least in gross revenue, grossing 20-odd, 30-odd $million a year, and they're paying their front man like a couple $100,000 and all these. It's a huge, huge scandal in the kiddie world these days. And
it's like stepping into a rock band. You're the drummer that died in Metallica or whatever. Then you put a new drummer in or a bass player. You're kind of stepping into the candy zone there. You just don't screw it up. I mean, basically.
Yeah, exactly. These guys have stumbled into riches beyond their wildest belief. Talk about failing upwards in life, and now it seems like they might be killing the golden goose with their just silly antics, to say the least. So, Rob, I'm sure that was the unknown variable that really was wreaking havoc on the Australian dollar today.
Well, it took them the better part of a decade to recover from Yahoo Serious, so...
Who needs Sebastian?
Yeah,
We've got Rob to throw in Yahoo Serious references. We're all set.
That was definitely done.
But yeah, just this everybody kind of looking at Europe. Europe was a big focus today, and then of course China affecting some of the commodity currencies. Gold as a defensive play has actually been pretty good, but we ran up against this. The 1750 level with the overbought markets, so that kind of stalled out the gold rally for the time being. We rallied really well over the last few weeks in gold, so it seems that the focus. I've talked about this before, and it seems like the hot commodity is either in gold and the precious metals, or we're seeing crude oil and energies take the driver's seat. And crude oil has really stalled recently. The market doesn't know what it wants to do. We've had the Iranian tension. We've had supply issues here in the U.S. We're actually where we expected much larger supplies than what we have right now, which is kind of surprising given the fact that the economy is hardly moving at breakneck speed. But it's holding steady, and a lot of those traders have just kind of jumped on the gold bandwagon for a while. And but now that both markets have kind of stalled out here, it's going to be slow, choppy trading here.
Yeah, it seemed like Iran stirred it up a little bit with their, I suppose you can call it a faux day of rage there, where they were threatening a lot on the oil front, and a lot of it so far has not yet materialized. I didn't see anyone scrambling for the 200 strike calls like we saw last year coming out of this one, so perhaps it wasn't as dire as last year.
Well, I think sanctions are starting to work in Iran. I think if they stop exporting, they have no money. And I don't really know if their economy can handle that shock.
Yeah, and if you look at this is a week after the sanctions have actually started or they were passed through Europe. The initial statement out of Iran was very soft, and it didn't mention anything about the Strait of Hormuz. And now, of course, weeks gone by, and they've kind of rethought their strategy, and now they're back to the saber rattling. But yeah, ultimately, they know that the person that's going to, or the country that's going to suffer the most if they close down the Strait of Hormuz is Iran.
Yeah, it's kind of hard to keep a increasingly restive population under control if you turn off the spigot. You need some money to keep those people in line. And if you turn off that spigot, that flow of money is going to dry up, and then people will be definitely making some uncomfortable situations for the mullahs over there in Iran. So definitely, I think it was a lot of posturing myself before.
Yeah, they're good. I think they've gotten that down to a science now. That Ahmadinejad, I think he's the posture poster boy for the benevolent dictator in the Middle East. There aren't too many left of them. There's only a couple now.
He's definitely learned some branding lessons. He wears that same ridiculous members-only type jacket all the time. It's kind of like his. I believe there's like a company that sells them in Iran now. It's like it's kind of like his jacket line, kind of. So there's a lot of, and that kind of brings him back to his old revolutionary days. There's a lot of subtle behind-the-scenes, almost Western-style PR and branding that goes into some of that faux rage we see over there.
It's actually kind of funny because he's not conservative enough to make the mullahs out there happy, and obviously the more progressive younger people hate him, and so I mean, he's just kind of everybody's whipping boy. He's constantly trying to be everything to everybody. So he really, what was it, 2 years ago? He was really squirming because he thought he thought he was going to have to concede power there for a while.
Yeah, I think for his sake, he should hope that members only jacket is bullet resistant. Let's just let's just say. All right, with our talk of the mullahs out of the way, we can really, I guess we can talk a little bit about some of the tech vol is still edging downward. A lot of good buys lurking in tech land.
I think this is, I'm going to, again, what do you call it, degenerate juice buying?
Degenerate premium buying.
They are marking like, you know, I know rest mentioning Cisco on this show is painful, but Cisco Juice, Microsoft, Intel,
hey, Uncle eBay, Mike is not here today, so you can feel free to dive into Cisco.
Yeah, I mean, you're buying single-digit PE stocks at no vol. It's funny because in 2002, you could have bought, you know, Apple, Cisco, Microsoft, Amazon, eBay. I think you could have bought all those stocks for like $80 in total cash, you know, because Amazon was only $9 and eBay was $8. You know, all those stocks just got buried. So you could have bought a huge basket of, you know, now that basket's probably worth $3,000 or something like that. But it reminds me now of like you can get a PE ratio for growing tech companies and volatility. It seems like it's such like the lowest it's ever been for companies that generate this much money. It's like just nobody cares at all about them. So they're kind of like that NDX, you know, you just see it slowly kind of ticking up every week. It's not doing anything drastic, but it's steady. And that's the kind of stuff that drives volatility to nothing where it becomes an interesting purchase. So that's my, you know, degenerate juice buying junkie observation of the week. I've been watching it go down. It keeps going down, but the names keep going up. So that's my observation for you here.
We should put together our option block vol basket that we can just turn around and sell out to our listeners so they can come in and just buy vol across the board in one fell swoop. And then we'll handle the gamma scalping for you.
Options Express. Here's your you know, your juice basket. Instead of a juice box, it's a juice basket. And it's just, you know, just sends 10 orders to all the big tech stocks about 3 months out. And I think you just sit here and wait and you collect a lot of money in 3 months.
No, I think there would be a demand for something like that, where if you could come in and buy, let's say, a vol basket or vol on individual names and have someone who is savvy on the other end actually get you that vol by scalping the gamma for you to take that last intermediary step out of your hands. If you can come out and actually have someone marketing a pure vol fund like that would be an intriguing buy, I think.
Well, didn't the Amex have that product that was the volatility on individual stocks, and literally that was as good, about as popular as the individual stock binary options?
Yeah, Amex had a lot of problems though when they had some interesting ideas over there, like those binary names. Those were some interesting ideas. They just failed on the marketing and the promotional aspect, and that's kind of why those. And plus, Amex was having a lot of problems itself at that time. That was prior to the NYSE acquisition, which really revitalized that exchange. But so I think if they relaunch those products now, they might actually get some traction. I know SIBO's dabbling with the individual name fixes, but that's not really what we're talking about here. We're talking about something that could actually, you know, you can come in and buy this Apple product, for example, and be able to capture that, let's say, front month vol and have someone scalp for you and just pay out that vol for you. That would be, I think, an attractive thing for a lot of our listeners who like this idea. And we mentioned, hey, you know, you should come out and buy premium in these names, but they really have to be actively scalping to really collect the full return. And as we talked about on recent shows, you know, we talked in the past of people who don't know how to do that. Maybe they could, or they don't have time to do it. Maybe they could work options orders instead to do the scalping. But as we've seen recently, so much of the extreme ends of these moves occurs in the after hours. So you really need to be actively scalping the gamma in the after hours to really get the full bang for these positions. So That's a lot to ask for a lot of people, unless they come to you guys over there at Option Pit and you guys scalp for them, I suppose. That's another alternative.
We do stuff. We've created a strategy that we're trying to walk people through that process, just getting them used to just the idea of trading like this. There's so many ways to position options that most people don't think about because they haven't been exposed to it. Just besides the little stuff, the little charts you get. So it's a way to help people kind of walk through the process. So we're starting to work on that. So it's a good idea, Mark.
Maybe that'll be our latest product out of the Options Insiders. The Options Insider Gamma Scalping Service. Come to us and we will scalp you. We'll do the nitty gritty for you.
Yes, the Gammatron.
Yeah, exactly. We'll resurrect the Gammatron because that's the business I want to be in. I want to be in gamma scalping. That's where the money is these days. But yes, I think with talk of scalping tech vol, we should close out the old trading block today and dive right into the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the odd block.
All right, and with that funky, I feel like it's the intro to a Bond movie whenever I listen to that one. I love it. I just feel like getting up and doing some sort of Austin Powers type dance.
Oh, no, the music, the show's taking a huge uptick, no question. If you don't have your listenership hasn't gone up 25%, it should. Just tell them the music's cool.
See, we invest in the production here. That's why. That's the little quality differences that set us apart. That and we're pretty much the only people doing this. So those two things really set us apart.
No competition helps tremendously.
But it is, of course, time for the odd block. This is, as the man said, the time when we break down the interesting, the unusual, and sometimes the downright questionable options activity that is lighting up the old tape today. And we're going to kick things off with a big drug name, one that's been on the odd block in the past. Good old Pfizer. They actually have earnings coming out tomorrow before the open, so hopefully you got all of your positions on already because it's too late if you want to play in Pfizer. And what we saw today ahead of the earnings was some pretty much bearish sentiment lighting up the tape in Pfizer. We had, starting off with some in-the-money call selling in the weeklies. So this is obviously geared right around earnings and looking for a pullback coming out of the earnings. We saw 2,500 of the Feb 21 calls going up today. It's being sold for about 44 cents a piece. Of course, Pfizer closed today at $21.58, up about a dime. So these calls have got a little more juice in them towards the end of the day. But these people obviously expecting Pfizer to gap down pretty hard coming out of the earnings tomorrow. We also saw someone taking a wee bit more of a longer-term bullish look here at Pfizer, picking up a 2,000 lot of the April 1922 put spread, going up, like I said, 2,000 times for a net of $1.09. And on both of these strikes, pretty much 700 and 300 contracts respectively. So this is all opening paper here on this April put spread here. So we see some people coming in near term selling Pfizer, as well as some longer term bets that the drug market just ain't what it used to be. And it's time. It's time to get out of Pfizer. I know we talked a lot about the smaller pharmaceuticals in the past. I believe we actually have a few coming up here today in the odd block, but this is one of the larger pharmaceutical names. Andrew, you play it all in the pharma sector?
No, I thought, Pfizer's always been a fairly good, decent stock to write puts against, to be honest, because it just really doesn't do much. So nothing recently in Pfizer. I looked at some of the names like in December, but nothing really that has turned me on in the short term here for those guys.
Yeah, it looks like it's not turning on these people in the short term as well, because like we said, we saw a preponderance of sales going up here in these Feb 21s. Yeah, I'm just looking at the tape here throughout the day, and yeah, it looks like a significant number of sales. Some purchasers too, so it wasn't
pretty aggressive though.
Yeah, and that is. I was thinking the same thing. That is pretty aggressive coming in on these Feb 21s and hitting them for 44 cents. With earnings coming out tomorrow, that's an intriguing play here. Looking at the Pfizer chart, As recently as the end of November, they were trading south of 20. They were trading about 19.5. So this guy obviously betting that they're returning to those days. Of late, they've been pretty much vacillating around 21.5 up to about 22. So this guy is betting that they're going to trend down towards the lower end of that range again. If they trend up, then those weekly calls not going to be looking too good for them. And then staying in the pharmaceutical arena, but scaling down in size a wee bit, we're going to move down to one of what Mr. Sebastian would refer to as an odd block special. This one is CTIC. It's Cell Therapeutics Inc. And the reason I call it an odd block special because it closed today down at $1.09, down 24 cents or 18% on the day.
Awful day for that stuff.
Yeah, not a good one for CTIC. This is the name that does a whopping 300 contracts a day. They did nearly 17,000 on the day today. A lot of bad stuff going on for good old CTIC. They withdrew a new drug application, which tends to be the kiss of death for names like this, and that, of course, hitting the stock pretty aggressively. We saw people actually selling coming into. There was some interesting paper going up today, which was kind of fun to pick up. We saw 5,000 lots going up each on the Feb 1/2 calls and puts. We saw the puts being sold for about 45 cents, and it looks like the calls might have been purchased for about a nickel, in which case this guy was legging into his conversion reversals around $1.10, legging into the stock around that level. Either that, it was kind of hard to tell on the splits with the calls. He might have just been selling the straddle outright as well for about 50 cents. Either way, an intriguing play coming in here to good old CTIC, selling that 1/2 straddle for 50 cents, obviously not thinking, if he is going that way, not thinking the stock's going night-night before the end of February. We also saw the June 2,500 of the June 1 puts being picked up for 20 cents, and the June 1/2 calls being sold. Looks like this guy legged for about 20 cents as well. It looks like someone else legging into a zero-cost 1/1/2 risk reversal out there in June. So this guy taking the opposite view, it appears, that between now and June, that there will be dark, stormy seas ahead for CTIC, and he's betting hard that it's going to be south of $1 for the next few months. And these two trades alone amounted to 15,000 of the 16, nearly 17,000 contracts that went up today. And like I said, it was kind of hard to parse whether or not that was indeed a... actually, let me look here really quick on the...
I'm trying to look for some stock on the tape.
Yeah, the stock, obviously, stock shares were going up quite a bit. That's what we looked for as well to see if there was... I didn't see anything tied to this that was going up in, the 500,000 share range that would have gone up tied with this trade. We saw a lot of large blocks, nothing that sizable. And we also... Let me look here... Yeah, you can't really tell. These are garbage calls. So looking at the vol is, but actually the vol did come in on these Feb 5 calls. So he could have actually, he might have sold that straddle, which is intriguing to say the least. An aggressive play. If he's buying the stock for 110, he's not really accomplishing much there. So I'm going to assume this guy came in and hit the straddle instead, which is an aggressive play for good old CTIC, betting that they're not going to bite the farm before the end of June. And we love to parse these $1 names in the odd block here because it is fun just to see what people will do with a $1 name and how many people are willing to come and batter up and buy calls for 30, 45 cents on a $1 name. It always amuses us. This time, looks like the people were being a little bit more savvy on this end and actually legging into some a little bit more interesting positions here in the old CTIC. Anything else to add here on CTIC, Andrew?
I just, sometimes I see this stuff and it just looks like a tempest in a teapot for me. To me, why somebody's going to a lot of trouble to, I guess, those are my head scratchers. I'm going to call those just head scratcher trades.
Yeah, exactly. That's kind of why I wanted to outline this a little bit, just to show some of the lengths some people will go to position themselves in a $1 name.
Right. The one I can understand, maybe the guy might be closing his straddle in February, but June, I can't do the margin it would cost to keep that trade on. It's a toughie. unless there's some stock against it or something. But
you know what? Actually, that might be a good point, because I'm looking here, and the open interest on the Feb 1/2s is about 6,000 on the calls and 5,000 on the puts. So this guy probably picked up that straddle earlier on, and he's just dumping it now. That would probably make some more sense there. We didn't notice those open interest numbers. So that probably is what he was doing. So definitely, yeah, it looks like he was selling the straddle. But you're right, with this June position, that's something that kind of goes unsung or unheralded, is the opportunity cost of holding that position until June. People forget that sometimes when they're putting on these positions. Oh, it's a zero-cost position, I can just put this on. But there are other external costs at work when you're positioning like that in some of these names. All right, and we're going to close out the odd block today with a name that was lighting up the tape today. Good old Ren Inc., ticker symbol RENN, closed at $6.31, up $1.06 or 20% on the day. And this is a Chinese social networking company, so it looks like the rumors of a Facebook IPO have spread the love to Ren as well, because people were lighting up the tape today in
wow, what a squeeze in this thing.
Yeah, exactly. We saw, usually his name does about 3,800 contracts a day. It did over 72,000 today. So a very, very sizable trading lighting up the tape today in Ren. That's a great ticker symbol, Ren.
Well, yeah, this was a $22 post IPO high for this thing for this last year.
Looks like it was up in the 24 range. It got up to.
Yeah, and the low here just recently of the year was like in the 3s. Yeah, I mean, this is definitely some people loading up here at the bottom.
Yeah, and we saw paper just across the board today. You're talking that many contracts, 70,000 plus contracts. There was paper lighting up the strikes everywhere we looked. We saw about 12,000 of the Feb 6 calls going up. The bulk of them purchases. Since the stock had a pretty big range today, the calls had a pretty big range as well, lighting up anywhere from 65 to 90 cents. People selling the Feb 5 puts, 4,600 of those went up today at prices around 25 to 30 cents for the bulk of those sales. 7,000 of the Feb 7 puts, ironically, a lot of those were purchases, actually. Prices ranging from $1.25 to $1.60. So some people could have been legging into that 5-7 put spread. So an interesting assortment of activity. Feb 7 calls, 5,000 of those going up today. They were pretty much mixed, but there were quite a few purchases mixed in there in the 50 to 60 cent range. So some people thinking that there is more upside to go here in Ren, maybe thinking we're going to go back to those halcyon days of 24 before the end of February. Probably not, but interesting nonetheless. And then, of course, the April 6 calls. Some people out there taking a little bit of a longer view, 5,400 of those going up on the tape today. The bulk of those purchases as well, ranging from $1 all the way up to about $1.50. And we saw vol on that strike, not surprisingly, up about 3% on the day, given all of the purchasing activity. So the bulk of these trades were indeed on the long end of the equation. It could have been, as Andrew alluded to earlier, part of a short squeeze lighting up this name, people looking for deltas wherever they could get them. It also could be people looking at the charts and saying, well, here comes a new wave of social networking names. Ren may catch some of that wave as well, so we might as well pick it up here on the cheap, or a combination of all of the above. But yeah, definitely if you've been a heavy short in Ren, it probably is a good time to take your money off the table with the new social networking IPO wave and the name everyone's been waiting for, Facebook, looking to come in the near term. Then you probably want to take your shorts off of the table, and that probably was a lot of what we saw today in Ren. People looking to gobble up the underlying as well as take some deltas off the table by picking up the calls as well, and also sell some puts for the most part. So interesting activity here in Ren. People just lighting up the tape on strikes across the board. Always fun to see these Chinese names just lighting up the tape. Between this and Baidu and a few others, I know they've been keeping the boys at OX relatively busy. And speaking of the boys at OX, our good old friend Rob had to leave early on a preschooler emergency, and we know how those are, so I hope Rob's daughter is feeling better. So we're going to skip the old Express block today, and instead we're going to roll right into the listener mail block.
Listener mail. Listeners write in.
Mail's in.
Mailbox.
All right, and that high-paced music means it's time for the old option block mailbag. And our mailbag is actually looking pretty dusty because we haven't opened it in quite a long time. In fact, this question came in several months ago, and we've just been so busy doing other things on the show. We haven't gotten into the old mailbag, and that is my fault. I should be bringing up more listener questions on the show. I know a lot of you have written in saying, hey, what happened to my question? So we'll try to get to more listener questions on the old show here. And today's question comes in from our Options Insider forum by a listener who goes by the handle Afalde, I suppose you pronounce that, A-F-A-L-D-E. And he writes about the weekly butterfly risk and reward. He says, I've seen recommendations to take profit equal to risk instead of trying to get the peak profit on butterflies. I totally agree with this. Now, the question I have is, what should be the relationship of debit to risk? I lean toward making my debit the full risk and leaving enough upside to make a one-to-one return. And in my example below, I have, if I can buy 10 contracts for a debit of 80 cents, my peak profit in this example would be $3.50. My maximum loss would be 80 cents and a profit taking of plus 80 cents versus a scenario where I buy 20 contracts on a debit of 80 cents. My peak profit is $3.50. My maximum loss is 40 cents. My profit taking would be 40 cents. So risking the same amount to make more contracts to make possibly less, but also having less loss on the downside. But then he writes, since weeklies have so much gamma risk, it makes sense to me to define max risk as the debit instead of worrying about exiting if the market is moving quickly. What do you think? Other ideas? And I have my own takes on this, but Andrew, since I know you like to play with the flies, I will let you take on this one. What's your take on his good old Afalde's question here?
Yeah, I think that was, it was a good question from a listener. One thing about flies are, number one, obviously, you want to get that debit down as low as possible. The second part of a fly is, from the risk-reward point of view, the delta is really small. Now you can game the delta, right, a butterfly by where you set it. You set it way out of the money, you set it way in the money. You can game the delta, but really the idea of a butterfly is you're trying to buy some movement and have the short options pay for your delta. So I think setting up and he just answered really his own question. The weeklies have so much gamma risk, right? So that also means that the weeklies move a lot. So if you're going to use a fly, you want, it has to be with the expectation that the underlying is going to move in the direction you want. You're not going to make a fortune on the underlying movement and collecting more than the debit you paid. So what you really have to do is set a cheapy debit up away from above the strike if you want to be long, or below the strike if you want to be short. Where the stock price is. And you want to game your butterfly, so you're paying like little tiny debits for the shot at, a little pop up, right? Because that gamma is going to change that near at the money, or your nearest call, because generally the fly you're buying one, selling two, and then selling the more out of the money call. So a little move up in the stock is really going to affect that closer long option you have first. And if you have a little volatility compression, the two calls you're short will come in, and that actually makes your fly look a little good. So, if you're going to use a fly like that, you really want to play the fact that the position is going to work that way because you have such a small delta in general. So that's setting a fly up short term. Normally, we like to set up flies where the underlying volatility is just not moving. You set up a fly, a long butterfly that is, with the intention of the underlying really not moving very much. And in this case, he actually wants to use a fly for a trade in a gamma heavy area. So he actually has to use the way the fly is constructed and kind of set it up slightly away from where the name is trading it, depending on if he's kind of bullish or bearish.
Yeah, no,
so that's my take on that.
Now, we've talked on the show in the past. I'm not a big fly guy. I'm much more of an iron fly as opposed to the old standard plain vanilla flies. They bore me. But I thought this was an intriguing question because we don't get too many people writing in about flies in the weeklies. That is a pure gamma play at that point. And you're right. It has a very, very directionally heavy heavy play. And unlike a longer term fly, we might have some movement, and you could scalp, as we're always so fond of talking about, you could scalp the vol, scalp the deltas, scalp your gamma, and make some longer term money on the name. The weekly fly, you're not going to have that opportunity. You're going to get pretty much one move, and you have to take it and take it off the table. The opportunities to scalp a weekly fly, I think, would be minimal at best.
Right.
You certainly can't rely on that as a long-term profit potential like you can in a longer-term fly where you have a little bit more nuance, a little bit more wiggle room, and you can scalp yourself and keep yourself afloat waiting for that big bang to happen. The weeklies, you're pretty much, it's a quasi lottery ticket at that point. You're really, if you don't get that big bang in that week, doesn't matter how you profit, how you structure it. I mean, I guess in that sense, I would agree with you. I would probably want to go for the minimum debit on these as opposed to the larger debit because you're doing a stake management game at this point. You're picking up these essentially roulette spins or lottery tickets, and you want to keep managing your stake so you can survive long enough to get that big bang. And so that's probably the way I would go with this if I would do this at all. I think the notion of a long weekly fly, I guess, is better than buying straight upside in a weekly option or going along that sense. But yeah, this is I thought it was an intriguing email because it brought up some intriguing scenarios we haven't discussed in the past. But definitely an interesting one, and I think your mileage will vary. But not my chosen strategy. But if you do manage your stakes so you can stay in the game as long as possible. Hope that helps you. Good old Afalde. Any closing comments there, Andrew, before we close out the old listener mailbag?
I like, again, low underlying volatility environment for a fly. Kind of works better with the indexes and ETFs that are kind of sleepy anyway. So, it's very much fitting a position to the underlying condition than the other way around. It's like, okay, I'm going to throw flies out everywhere. You don't think about it like that. You're like, okay, here's a market condition. What position actually is the best type of position? And that goes more toward what you're saying, Mark, where you see these things are happening and, you throw your butterflies away and you actually look at the types of positions that might fit a little better than a fly. So
yeah, we don't know how this guy is constructing these two, if he's jumping to different earnings names every week or if he's doing the same name every week or what exactly he's up to here. So there's a lot of different ways you could construct these in a perhaps more nuanced way to increase your probability of having that big move over the course of a week. But yeah, it's an interesting scenario to ponder, particularly for all of our weekly traders out there. Of course, 99.9% of our listeners out there who are trading in the weeklies are probably selling the calls to this guy or selling the contracts to this guy. They're not buying weeklies. So,
yeah, exactly. They're like, hey, here's the fly guy again. I'm going to sell him more.
Exactly. Another good reason to bring this one up, just to show that, hey, there are people out there who actually buy the weeklies. All right, and that is going to do it for the old mailbag. And now we're going to roll right into Around the Block.
Around the Block.
All right, and that traffic noise means it's time for our Around the Block segment. This is the portion of the show where we look into the murky ether of the future and attempt to divine what the markets hold in store for us, or at least discuss what we have on our own personal trading screens for the rest of the week. And we still are in the heart of earnings season, so a lot of people still have earnings on their mind, and so a big one coming out tomorrow after the close. You talked about tech vol before in the trading block, and Amazon coming out after the close tomorrow. Amazon, another one that has been heading north of late. And the vol out there is comparably cheap to, or comparably cheap to, something like we're seeing in Amazon or in Apple. Perhaps not quite as cheap as what we're seeing in Apple, but still a decent buy, particularly if you're looking at something maybe a little bit longer term to get some of that earnings move, but also a little bit longer term horizon. What's your take here on Amazon these days, Andrew?
The thing is, I'm still trying to figure out, with all the competition that Amazon has, why it garners like 100+ PE. They compete against Apple on the Kindle. They compete against Microsoft and every other cloud company on the cloud stuff. Although they're pretty dominant, obviously, in just ordering stuff on the web, but they don't make a lot of margin there. They've got some stuff going on. I think it's a great company. I've never been able to figure out the multiple And the stock hasn't performed over the last, 4 or 5 earnings that great after earnings. So if anything, I'm not generally a pre-earnings type player guy, but I would bend toward the idea of, probably buying some put spreads in the thing or something like that. So one good thing about the weeklies, you only have to put out a little bit of dough for something like that.
There you go. That is
shot.
Exactly what the weeklies were constructed for, is for speculating on and or hedging around particular events like earnings announcements. And I'm looking here while you're talking. And Andrew, you are dating yourself talking about all these fundamental concepts. Who looks at PE when we're looking at option vol? Really? Does it really matter if the underlying company is making money? And you're right, today Amazon closed at nearly 103 PE. And if you're a fundamental guy, compare that to Apple, which I believe is in the 12. Today it closed 12.7 PE on Apple. So if you're looking at it from a purely fundamental perspective, then you definitely want to load up on some downside here on Amazon over the longer term, because you're right, they are competing in similar spaces now. They're a hardware manufacturer on multiple fronts. They have the Kindle as well as the Kindle Fire. So they're starting to get into those low-margin type businesses, as well as their streaming video. So they're competing with Netflix. They do a lot of the backbone of the web, so they're very much a data and infrastructure play as well. Amazon is very much one of the more broad and diverse names you could pick up these days. But on the flip side, they are charging a hefty premium for that. You're right.
And it does make a decent kind of ratio call spread stock if you can get, buying 2, selling 1 for a credit. If the stock craps out, you make some money. If it explodes, you make some money, because you do get that kind of underlying rip one way or the other. We've had some pretty good moves out of Amazon over the last couple months. Moves from 170 to 200 and back, and so. I mean, that's the kind. To me, it's hard for me really to pick a direction in this name, because I don't get why it's here in the first place. So, just waiting along. I don't think of mid 40 volatility is a bad back spread in an earnings name like this, where you hold it for about 8-9 days. But that's probably the best way I can think to trade it through this cycle.
Yeah, I'm going to throw away the vol measures for the weeklies, because the vol is meaningless in the weeklies. Looking at it on the pure debit credit perspective, looks like they're pricing in about a 17 handle move going into earnings tomorrow on the weeklies here. And like I said, Amazon closed at 192, so that falls well within the range of where the stock has been lately. Not exactly a extreme valuation level, but not terribly cheap either. So like we said, not exactly as cheap as, let's say, an Apple right now from a purely vol perspective, perhaps, but not exactly super expensive. So if you're looking for some bang for your buck, and since it is the season lately, everyone's going into earnings long premium for the first time in a long time, then I thought we might as well throw Amazon into that mix as well.
Yeah, like 170, 170 puts, 170, buying the 170 puts in the regulars in Feb, and maybe selling the 60 puts in the weeklies or something to help you with that vol crush, and possibly set you up for something if Amazon gets softer here. So something like that, relatively low dollars, gives you a little time, and because the IV will come down about 10 or 11 points at least in Amazon in the February ordinary. So I think you try to cushion that to the extent possible, and play some kind of small delta there.
That's what's made the vol and some of these other names you talked about before, like Google and Apple, so attractive of late. Is they were pretty cheap already going into earnings, even with the earnings inflated premium. Then earnings came and went, and the vol came out even more. And so you have names that were already attractive going into earnings are still looking extremely attractive, if not more so, with the post-earnings deflation. And so perhaps we'll see an interesting scenario like that in Amazon, where maybe the name will come off a little bit, and yet the vol will also come off substantially going out of post-earnings. And so you have perhaps a more attractive scenario like you're seeing in Apple right now, or even in a Google, which went down heavily, and yet the vol is still off. So an intriguing scenarios in all these names. Maybe Amazon will follow suit, or who knows? Maybe they
think of it also too about what's a more fairly valued volatility for a market, for a name that's going to move like the market. Like you take a Google or an Apple that generally Apple might be starting getting out of category now a little bit, but names that are, how do you go and find broad market volatility super cheap? Because the indexes are relatively expensive relative to realized vol, but some of these big names are pretty cheap because they're moving around still a little bit. So it's another way to think about how to pick up juice in a market where, you might fear this Greece thing or this Europe thing, and these, Google can move $40 in a day without too much effort, or Apple can move $10-15 in a day, and that's enough to certainly finance one of those little juice positions when they're giving you the juice for nothing.
Yeah, or finance one of those weekly butterflies like we talked about earlier.
Or a weekly butterfly, exactly.
It all comes back to the weekly butterfly.
Weekly butterfly.
All right, I think with that, of course, we do have some numbers actually this week. Non-farms coming out on Friday, and this might be the first time in a while that numbers are actually meaningful again from a volatility and a trading perspective. I know for a long time we've been so concerned about other macro factors going on in Greece and the S&P downgrade and whatnot that things like non-farms never really seem to roil the market too much. But this week it might actually might see some numbers pop going on towards the end of the week again. So that'll be interesting to watch as well. And any other earnings really catching your eye here, Andrew?
What do I've got? I don't have, again, I try to avoid earnings in general. So I kind of wait till
after. What fun are you, sir?
I know. Rambus, we did a little thing at Rambus last week. I'm looking at First Solar, the front month volatility in here look kind of cheap to me coming into earnings, although it's not the earnings cycle. It's just the thing's been a monster. So again, relative cheapness. There is some opportunities now where that front month vol prior to earnings, if it's not on the earnings cycle, gets ridiculously low in this environment because the liquidity feels a little bit low and light. So this front month vol just drops to nothing. And even though it's just prior to the earnings cycle, you could catch a pre-announcement, you could catch anything, and you probably trade your way around it, at least to kind of break even. So that stuff is kind of happening. So, look for the earnings month, but also that you have a couple weeks or 3 weeks to go in this month that's going to expire just before earnings, but it's tight. You can pick up that pre-earnings announcement possibility or, any other kind of funk that happens because they're just letting that gamma go so fallow right now. So that's the kind of trade I've been looking at.
Fallow gamma. I like it. Maybe
gamma.
Maybe that'll be the title for this episode. I like it. All right, and I think with that is going to close out our Around the Block segment. That's also going to do it for this episode of the Option Block. I, of course, want to thank all of my cohorts, my partners in crime, for joining me on the show today, and we want to send our get well soon wishes out to Big Rob's little girl there. Hopefully she will recover soon. Something nasty is certainly going around these days in the preschool set. We had it rage through our house last week, and it wasn't too pleasant. So hopefully they will burn through that pretty quickly and be back on the healthy side relatively soon. I also want to thank good old Andrew for joining me today and helping me to hold down the fort when everyone else was called away at the last minute. So Andrew, what is coming up in the land of Option Pit that may interest, intrigue, and perhaps even titillate our listeners?
Well, we're following on the heels of our once a month free webinar series. And surprisingly enough, I'm going to do a webinar next February 15th on trading around the earnings cycle. So just exactly the stuff I described, kind of non-standard positioning of options, looking at volatility, pre and post earnings. So instead of people just betting on the earnings per se, they actually can bet on some of the things that can happen prior to or post, which gives them a little better shot than kind of just waiting for, the big print and the big announcement. So that will be on the 15th February. Mark is also hosting another VIX presentation, which I have to get the date for you. I still don't know that one, but I know it's VIX or SPX is coming up too. And those have been really well attended. So we're happy. We're very happy.
Glad to hear it. And speaking of the free webinar crowd, I usually tend to avoid those. So many other things going on. But of late, the folks over at ICE, not ISE, but ICE, are looking to get into the options realm, and they made me an offer I could not refuse to help them get started on the options landscape. So it was appropriate that we were talking about weeklies so much this episode, because I will be talking with them about the weekly options, particularly in some of their new ag products coming up. This webinar will be on Thursday at 1:30 p.m. Central, I believe, and you can find the link in the show notes. It will also be up to register on the optionsinsider.com, where you can go to ICE. That's THEICE.com. If you go to ICE.com, you'll get the jewelry folks over there. So unless you want to buy an engagement ring, it's the wrong URL for you. I've made that mistake several times in the past. But so, yeah, it'll be an interesting discussion. We'll talk about weeklies in the ag perspective and how, or just in the futures perspective in general, in the futures options perspective, and some of the interesting reasons why that use case has differed so markedly from what we've seen in the equity options side, where ever since they've listed equity options or weekly equity options, it's been just a race to hit the bid and ride that vol all the way to zero, whereas on the futures options side, it's a much more nuanced use case, and people are actually buying these things. In particular, buying them towards the end of the expiration cycle with 1 or 2 days to go. So that is a almost polar opposite use case on the futures option side versus what we've seen on the equity option side. So we'll get into that a little bit and some of the reasons why that may be happening and some of the reasons why these products are so similar yet so different in so many ways. So there'll be interesting stuff to talk about. Come join us on Thursday. It'll be right before we record the option block on Thursday. So my voice will be quite tired by the end of the day. But it should be fun nonetheless. Look for that registration link in our show notes or on the optionsinsider.com, and come join us on Thursday. And thanks again for downloading and streaming and subscribing to this program and making it such a success. And we'll see you next time right here on the Option Block.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting, and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.